Right now, Wall Street's chasing $200 AI stocks, but 5 companies under $15 could deliver 300% returns before Labor Day. There's a voice AI firm with a $1.2 billion backlog, a flying car company one FAA signature away from launch, and an autonomous robot maker rolling out 2,000 units with Uber. These aren't penny stock scams. They're backed by revenue, contracts, and institutional capital most investors overlook. Meet Harry. 6 months ago, he had $85,000 in savings and felt priced out. Today, he's up over $240,000, just by spotting what Wall Street hadn't yet. He didn't chase hype. He found real businesses with explosive catalysts before the crowd. And now, with the next 90 days packed with game-changing events, you'll see exactly why this strategy could change everything. But first, this is educational content, not financial advice. Always do your own research. The voice AI company that's about to shock Wall Street. Trading at just $11.97, there's a company that's quietly building the infrastructure for the next digital revolution. And most investors have no idea what's coming. SoundHound AI isn't just another artificial intelligence startup throwing around buzzwords. They're the voice behind Mercedes-Benz cars, Hyundai dashboards, and those AI assistants taking your order at Chipotle drive-thrus. But here's the part that should make every financial independence seeker pay attention. They've got a $1.2 billion backlog. That's not projected revenue. That's contracted business already in the pipeline. To put that in perspective, their 2024 revenue was just $102 million. This backlog represents more than a decade of growth at current levels. This is exactly the type of asset allocation opportunity Harry spotted early. While others chased expensive AI stocks with no guaranteed revenue, he found a company with contracted business worth 10 times their current market recognition. The compound interest effect here is staggering. Every new voice integration creates network effects. More data makes their AI smarter. Smarter AI attracts bigger customers. Bigger customers generate more revenue and data. It's a virtuous cycle that could accelerate exponentially. Recent momentum is building fast. Q1 revenue exploded 151% year-over-year to $29.1 million. Management is guiding for 95 to 100% growth in 2025. But here's the catalyst that could trigger a massive breakout. Their Q2 earnings report drops in early August. If they show accelerated conversion of that massive backlog into recognized revenue, this stock could gap up 40 to 50% overnight. And there's another explosive element most people miss. 33% short interest. That means 1 out of every 3 shares is held by someone betting against the stock. If positive news hits, those short sellers will be forced to buy back shares rapidly, creating what's called a short squeeze. We've seen this movie before. When shorts get trapped, stocks can move 100 to 200% in days, not months. The investment strategy here isn't complicated. You're buying a profitable, growing company with massive contracted revenue at a reasonable price, before Wall Street fully recognizes the transformation happening in voice AI. But the voice revolution is just the beginning. What if I told you there's an even bigger opportunity in the skies above us? The flying car company that's about to take off. Forget everything you think you know about flying cars being science fiction. Archer Aviation, trading at $11.04, is about to make urban air mobility as common as calling an Uber. Here's what most money management experts are missing. Archer isn't just building flying vehicles, they're creating the entire ecosystem for 3-dimensional transportation. And they're closer to commercial operations than anyone realizes. They've already secured 3 of the 4 critical FAA certifications needed for commercial flights. The 4th and final certification, type certification for their Midnight aircraft, is expected by late 2025. That's not a vague, someday timeline. That's a concrete regulatory milestone with massive wealth-building implications. Harry saw this setup developing months ago. A company with breakthrough technology, major partnerships, and a clear regulatory pathway to massive revenue generation. The market hadn't yet priced in the transformation about to unfold. But here's where it gets really interesting. United Airlines isn't just watching from the sidelines. They've committed to purchasing 200 Midnight aircraft and plan to launch passenger services in New York City by 2026. Stellantis, the automotive giant behind Jeep and Ram, serves as their exclusive manufacturer and has invested millions in the partnership. The asset allocation opportunity here is unprecedented. We're talking about positioning in a market that could reshape how millions of people commute. The total addressable market for urban air mobility is projected to reach $1 trillion by 2040. Current market cap sits around $6 to $7 billion for a company that could be generating hundreds of millions in revenue within 24 months. The financial goals alignment is perfect for growth investors willing to accept higher risk for transformational returns. Recent institutional accumulation tells the story. BlackRock, ARK Investment Management, and Vanguard have been steadily building positions. Smart money is positioning for the regulatory catalyst that could unlock commercial operations. But if you think AI and flying cars are disruptive, wait until you see what's happening in government contracts. The AI defense contractor Wall Street forgot. While everyone's debating consumer AI applications, there's a quiet revolution happening in the most secure buildings in Washington, D.C. BigBear.ai, trading at just $7.87, is powering artificial intelligence for national security, and the Pentagon can't get enough. This isn't speculative investment research. This is contracted revenue with the most reliable customer in the world, the United States government. The numbers are staggering. $385 million backlog, more than double their projected 2025 revenue. A 5-year, $165 million sole source contract with the U.S. Army. Deep involvement in Project Linchpin, integrating AI into critical military systems. Harry recognized this as the perfect financial planning opportunity. A growing AI company with predictable government revenue streams, trading at a fraction of commercial AI valuations. But here's what should grab every financial planning expert's attention. Government contracts aren't like consumer subscriptions that can be canceled with a click. These are multi-year commitments with built-in renewals and expansion options. The passive income streams are predictable, growing, and backed by the full faith and credit of the U.S. Treasury. Recent performance validates the thesis. The stock has already surged over 380% in the past year, but analysts suggest another 100% move could retest all-time highs. Why? Because the conversion from backlog to recognized revenue is just beginning. Q1 revenue grew 5%, but management expects significant acceleration as contracted work moves through development phases. Each converted contract doesn't just boost current revenue. It demonstrates capabilities that win additional contracts. The compound interest effect of government contract renewals creates a sustainable competitive advantage. Once you're inside the Pentagon's trusted vendor network, expansion opportunities multiply exponentially. The investment strategy here leverages something most investors overlook. Government spending on AI modernization is just getting started. While commercial AI companies fight for market share, BigBear has secured multi-year contracts that provide revenue visibility into the next decade. But defense contracts aren't the only place robots are taking over. There's a delivery revolution happening on sidewalks across America. The robot army that's already deployed. Forget about robot deliveries being the future. Serve Robotics, trading at $11.40, is already operating autonomous delivery robots on sidewalks in major cities. And they're about to scale exponentially. Here's the wealth-building opportunity most investors are missing. This isn't a concept stock with fancy prototypes. Serve has completed tens of thousands of real deliveries for Uber Eats and 7-Eleven. Their robots are navigating complex urban environments, delivering food and packages without human intervention. Harry spotted this opportunity early. A company with proven technology, major partnerships, and a clear path to massive scaling, all trading at a small cap valuation. But the real catalyst that could send shares soaring is their partnership with Uber to deploy 2,000 robots by year-end 2025. That's not a distant goal. They're already building and deploying their third-generation robots with improved capacity and battery life. The financial independence math is compelling. They've raised substantial capital and maintain $197 million in cash with zero debt. This asset allocation provides the runway to execute aggressive expansion without dilution concerns. Recent operational metrics tell the growth story. They've doubled delivery capacity, increased restaurant partnerships by 300%, and expanded household coverage by 200%. These aren't vanity metrics. They translate directly to revenue growth and improved unit economics. Geographic expansion is accelerating. Recent launches in Atlanta, Miami, and Dallas-Fort Worth demonstrate scalable operations. Each new market validates their technology and creates additional passive income streams through delivery fees and partnerships. The investment research shows classic breakout patterns. Strong recent performance, operational milestones being hit, and institutional accumulation building. When the robot deployment acceleration becomes obvious to Wall Street, this stock could gap significantly higher. Revenue projections show the potential. Analysts anticipate the company achieving a $60 to $80 million annual revenue run rate once the 2,000 robot deployment reaches full utilization. That's 10x current revenue levels. The money management thesis is simple. Autonomous delivery is solving a real problem with measurable economics, and Serve is the pure-play leader positioned for explosive growth. But if you think sidewalk robots are impressive, wait until you see what's happening where crypto meets artificial intelligence. The crypto AI hybrid. Most investors don't understand. Galaxy Digital, trading at $32.29, represents something unique in today's market. A company positioned at the explosive intersection of digital asset adoption and AI infrastructure demand. Now, I know this stock trades above our $15 threshold, but Harry's investment portfolio success came from recognizing exceptional opportunities regardless of arbitrary price limits. Here's why this one is too compelling to ignore. While most investors see Galaxy as a crypto play, they're missing the bigger transformation. Yes, they operate digital asset trading and asset management platforms, but they're also building AI data center infrastructure that could generate billions in passive income streams. The asset allocation strategy here is remarkable. Their Helios data center campus has approval for 800 megawatts of power, with plans for an additional 1.7 gigawatts. To put that in perspective, major tech companies are scrambling for this type of AI-ready infrastructure. Jefferies projects that existing lease agreements with CoreWeave alone could generate $900 million in revenue at 90% margins. That's the kind of compound interest growth that transforms entire company valuations. But the real wealth-building opportunity comes from dual exposure to megatrends. Digital asset adoption is accelerating with institutional investors. AI infrastructure demand is exploding as companies race to deploy advanced computing. Galaxy sits at the intersection of both trends. Recent performance validates the strategy. Year-to-date gains of 58.3% reflect growing institutional confidence. Multiple analyst upgrades with price targets above current levels suggest continued upside momentum. The financial planning appeal combines predictable data center revenue with growth from digital asset services. Their 2024 counterparty trading revenue hit $215 million, while asset management fees reached a record $49 million. Looking ahead, projected data center revenue of $4.5 billion over 15 years creates a foundation for sustained financial independence generation. This isn't speculative crypto trading. It's infrastructure as a service with contracted revenue streams. The next 90 days could be explosive. SoundHound's Q2 earnings may trigger a 33% short squeeze if backlog conversion accelerates. Archer's FAA approval could unlock commercial flying taxis. BigBear's government contracts are ramping up, with Q2 results likely confirming faster revenue growth. Serve's robot army is scaling fast toward 2,000 deployments with Uber. And Galaxy's AI data centers are hitting key infrastructure milestones ahead of a 2026 revenue boom. These 5 companies represent different paths to wealth, from defense contracts to disruptive tech, but they all share 3 traits: real revenue, high short interest, and rising institutional accumulation. Harry didn't time the market. He positioned early, and it paid off. This is educational content. Always do your own research and consult a financial advisor. But if you're serious about building wealth, this summer might be your moment to act, before Wall Street catches on. Will you be ready?